Welcome back to Crypto Macro Insights. I'm Maya, and it's Thursday, August 28, 2025. 24 hours after yesterday's bombshell analysis about the reverse repo collapse, the data is getting even more extreme. The RRP facility has actually increased slightly to $34.74 billion from yesterday's $28.57 billion, but we're still looking at an 85% drop in 6 months. Meanwhile, the social sentiment has reached levels that can only be described as absolute psychological breakdown. How are you processing these intensifying signals?
Maya, what we're witnessing is textbook late-stage capitulation psychology meeting unprecedented monetary accommodation. That slight uptick in reverse repos to $34.74 billion doesn't change the fundamental picture. We're still sitting on nearly $200 billion of liquidity that has flooded into the banking system in just 6 months. But the human element is what's fascinating me right now. Yesterday, we talked about retail desperation and liquidations. Today, I'm seeing reports from Bulgaria about actual crypto murder gangs targeting holders, people fleeing to Dubai for safety. This isn't just financial capitulation anymore. This is existential fear reaching the crypto community.
Those Bulgaria reports are genuinely disturbing. We're talking about organized criminal groups targeting crypto holders with access to tax authority databases. But let's zoom out to the broader sentiment picture. I'm seeing this fascinating bifurcation you mentioned yesterday, but it's becoming more extreme. On one side, we have people discussing literal suicide after multiple liquidations. On the other side, we have Bitcoin maximalists advocating for 95% expense cuts, living on rice and beans to stack sats. Is this the kind of extreme polarization that typically signals major market bottoms?
Absolutely, Maya. This is exactly what you see at major inflection points. The Bulgaria situation is actually a perfect example. When criminal organizations start targeting crypto holders, it means crypto has become mainstream enough to attract organized crime. But the ecosystem is still fragile enough that individual holders feel genuinely unsafe. This creates maximum fear precisely when the macro environment is setting up for the biggest opportunity. Meanwhile, the rice and beans maximalists represent the other extreme, complete ideological conviction that transcends financial logic. When you have people willing to live in poverty to accumulate more Bitcoin, you know you're near maximum despair among retail. Historically, these psychological extremes coincide with the best risk-adjusted entry points.
Let's update the macro picture from yesterday. While retail is capitulating and literally fleeing countries, what's happening with our key economic indicators? You mentioned the VIX is staying remarkably calm. How are you reading that in context of everything else?
The VIX at 14.62 is telling us that institutional money isn't panicking at all, Maya. This is crucial context. While retail is experiencing existential crisis and literally fleeing to other countries, Wall Street remains calm. The yield curve continues its bullish steepening. We're now at 0.65% on the 10-year minus 2-year spread, up 160% in 6 months. This signals that the bond market expects economic normalization, not recession. Meanwhile, our reverse repo facility sits at just $34.74 billion. Meaning almost $200 billion in fresh liquidity is still sloshing around with nowhere to go but risk assets. The disconnect between retail terror and institutional calm is creating an unprecedented asymmetric opportunity.
Speaking of opportunities, we're now just days away from that critical employment data on September 4th and 5th that you flagged as make or break for this thesis. Given this intensifying backdrop, the continued liquidity flood, the escalating retail panic, the institutional calm, how are you thinking about those dates now? Have your conviction levels changed from yesterday's 45% bull case probability?
Maya, I'm actually increasing my conviction. The data from the last 24 hours has pushed me from 45% to 50% on the bull case. Here's why. The psychology has reached such extremes that even marginal disappointment in the jobs data could trigger massive institutional flows into risk assets. Remember, we have $200 billion in liquidity looking for a home, retail positioned for Armageddon, and institutions sitting on cash waiting for confirmation that the Fed can pivot dovish. The employment data doesn't need to be catastrophically bad, just disappointing enough to give the Fed cover for maintaining accommodation. Combined with Bitcoin holding relatively well at 111K despite all this psychological trauma, I'm seeing classic accumulation patterns from smart money.
I want to touch on another factor that's emerged in the community discussions: regulatory pressure. There's growing concern about the EU's DAC 8 reporting requirements starting January 2026, where crypto service providers will have to report all user activity to tax authorities. Are these kinds of regulatory tightening measures something that could disrupt this bullish thesis, especially when we're already seeing criminal targeting of crypto holders in some regions?
This is actually part of the thesis, Maya. Regulatory tightening and criminal targeting both stem from the same phenomenon. Crypto has reached critical mass adoption where it matters to governments and criminal organizations. The short-term effect is fear and capitulation among retail holders, which we're seeing now. But the long-term effect is institutional adoption and infrastructure development. Major institutions won't abandon crypto because of reporting requirements. They'll build compliant infrastructure. The criminals targeting holders actually validates Bitcoin's value proposition. If people are risking murder charges to steal it, it's clearly valuable. This regulatory pressure is pushing crypto from the shadows into legitimate financial infrastructure, which is ultimately bullish for prices even if it creates short-term uncertainty.
Tom, as we wrap up today's analysis, if you had to give our listeners one key insight from today's escalating data, the continued liquidity flood, the intensifying retail capitulation, the regulatory pressures, the criminal targeting, what would be your main takeaway?
Maya, the key insight is that we're witnessing a perfect storm of contrarian signals reaching historic extremes just as the macro environment provides unprecedented support. When criminal organizations start murdering Bitcoin holders and retail investors are discussing suicide after liquidations, while simultaneously $200 billion in fresh liquidity floods the system and institutions remain calm, you have the setup for one of the most asymmetric trades in Bitcoin's history. The employment data in 6 to 7 days will be the moment of truth. If those numbers disappoint and Bitcoin breaks 115K, we could see the most violent squeeze since Bitcoin's early days, but this time backed by institutional infrastructure and massive liquidity. The psychological pain we're seeing now may be the price of admission to the next monetary regime.
Powerful analysis as always, Tom. To summarize for our listeners, the liquidity flood continues with reverse repos at just $34.74 billion. Retail sentiment has reached genuine existential crisis levels with reports of organized crime targeting. Yet institutional calm persists with the VIX at 14.62. This creates an unprecedented contrarian setup where maximum fear meets maximum monetary accommodation. The critical test comes September 4th to 5th with employment data. Weak numbers combined with a Bitcoin break above 115K could trigger the most asymmetric opportunity in crypto history. But remember, this extreme environment requires extreme discipline with position sizing and risk management. We'll be back tomorrow to track these extraordinary developments as they unfold. Until then, stay safe, stay disciplined, and keep watching those employment numbers.